Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week, the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. This week, we're training our lens on gold. The yellow metal has rallied sharply to hit some 2024 high forecasts already. We're asking our panel on this week's show to explain whether they think gold will keep its hold on investors and why. The policy environment, structural demand and risk environment are combining to point to continued medium-term upside in the price. The Fed is apparently on track to begin rate cuts this month, and ETF demand looks set to keep growing. Our panel will unpack all of this and explain why geopolitics and election-related risks continue to justify holding gold as a portfolio hedge. Joining us this week, we have Giovanni Staunovo, commodity analyst, and Wayne Gordon, cross-asset strategist at UBS Global Wealth Management. We spoke this past Friday, the 6th of September. It was a pleasure to welcome Wayne and Giovanni back to the show. Wayne and Giovanni, let's talk about gold then. It's been making headlines in recent, weeks and days even. Really interesting just to get your sense. We've got prices that continue to hover around close to record highs, I think tracking pretty close to what you and your colleagues had estimated. I think we hit the sort of September numbers a little bit earlier. But Wayne, let me come to you first of all. Just give us a sense of what's been happening just in recent days and how much that accords with expectations or maybe surprised on the up or down side. Just give us a bit of an overview of where we are right now.
We came into the year with a pretty positive view on gold because we did expect that there would be some cuts to US interest rates this year. And we also expected that data would start to slow down and the US dollar would start to weaken. And we've seen these trends really start to pick up some pace over the last few weeks. The really great thing that we've observed over the last couple of days is that despite, this significant market volatility, particularly in the technology sector, which has done very well this year, not probably better than has certainly risen more than gold, but nonetheless, gold has also done very well. But the technology sector has been down pretty sharply over the last couple of days, yet gold still remains flat. And the reason why this is really important is because we see gold as portfolio insurance or a hedge against, uncertainties, whether it be of the geopolitical variety, the political variety, as we go into the US election, or a pickup in market volatility. And so gold is doing exactly as it should. It's providing people a hedge against, potential dollar weakness, potential recessions in some countries, and this sort of uncertainties that we had seen coming towards us at this time of the year into the end of the year.
Yeah, that's really interesting. And as you make the point there, when there are unpredictable circumstances, when things are volatile, of course, we know what tends to happen. But Giovanni, if I can come to you, there are also things that will shape the direction of travel for gold. And even though we may not know the detail, we have a fair idea they're coming along. I'm talking about things that Wayne's already alluded to, potential rate cuts in the US. But there are other things. We've got a US jobs report coming out. How sort of immediate and predictable, if you like, are some of these things in terms of the impact that they may or may not have on the gold price?
Few additions to the already great comments from Wayne that I would also make before coming to your question. One is a bit related to the fact that US interest rate stands at multi-year high at the moment. There has been still no cuts. There is expectation of large cuts. And the gold price stands at the record level, the moment slightly below the record level we reached a few weeks ago. And there are other trends which Wayne alluded with the geopolitical part, supporting the price of the gold. We have seen extremely strong central bank demand, driven on fears of potential sanctions impacting their assets, but also strong demand out of Asia due to weak Chinese economic data, weak real estate market, weak equity market, looking for alternatives. And this is a bit offsetting the pure direction of US economic data. Definitely short-term oriented investor, so-called hedge funds, will look at payrolls data as it influenced the Fed decision. But I guess at some point the Fed will cut with the slowdown we see of the US economy, and these investors, which so far has been a bit more absent, the Western investor, will start to pile up and buy also additionally on top of these purchases that we have seen in other parts of the world.
Well, yeah, and just on rate cuts, it's interesting. There are some who predict, what do they call them, kind of supersized rate cuts in response to data and other pressures. Does the pace of cutting and the scale of cutting, how direct is that impact when we're looking at through the prism of gold prices, Wayne?
Look, I think, and just to add on there from what Giovanni has said, I think the clear thing is that the pace of interest rate cuts certainly do have an impact. And in particular, the pace of those cuts relative to why they would be making these cuts. So just as an example, we look at the payrolls data coming out a little bit later today. Now, clearly, markets are pretty finely balanced. If payrolls are better, clearly those risks or greater risks of a recession in the US are somewhat further allayed. But if payrolls are weaker than expected, then those risks around recession begin to come back to the fore again. And we see particularly lower 10-year yields and lower 5-year yields as a result. And we would also see this exceptionalism, which the US has continued to display since the end of the pandemic. This exceptionalism will start to erode, and then you'll start to see the dollar weakening on a broader basis even more. These sort of things are what supercharges gold. So we have this expectation that you will have a fairly linear sort of rate cut path, albeit we think that it's probably starts off with a 50 and then we move to the 25s. But nonetheless, this sort of linear rate cutting path does mean that the increase in demand from exchange-traded funds, for example, that Giovanni talked about before, that will be also a little bit more linear in continuing to increase as real interest rates in the United States begin to step down more fully, i.e. the opportunity cost of holding gold in that context. So if we get much weaker data, the dollar will weaken more quickly, and people will not just be thinking about gold as a hedge against equity market volatility in that context, but also a hedge against dollar weakness. Remembering that, many people in their portfolios have a US dollar bias. And this is where we're seeing a real pickup in interest from the people that we're speaking to, is around this desire to just start to hedge the potential for downside for the dollar against a whole broad range of G10 currencies over the next 12 to 18 months. And so we can get there more quickly, as we happen to have done. We started the year with a September forecast around the sort of 2,500 mark. We've reached that more quickly than we expected. Upside for gold here is around 2,700 on a 12-month basis. But clearly, if the US economy weakens more and rate cuts come more quickly, we will reach that target potentially by the end of the year, if not the start of next year.
Well, yeah, and just on values, and this may be unhelpful to add in here, and it may be my sort of journalistic nose for a headline, but hitting 2,500, of course, means, I think I'm right in saying, that a single gold bar is worth $1 million, which has a sort of pleasing roundness to it. And just to that point, lots of people talking about the direction of travel for next year. I know you've given us your estimate there, Wayne, but talking about, it's only a matter of time till we hit $3,000. Is it unhelpful that people do that? It's understandable, I guess. As I say, people like these kind of round numbers, don't they? But is it unhelpful when we start to get that kind of narrative, or does it not really make any difference?
From my perspective, I think gold is merely responding to, as Giovanni said earlier, not just financial market trends, but also more sort of longer-term geostrategic trends. And why do we have a situation where ETF holdings of gold have been declining for almost 2 years, or even around 2 years, correct me if I'm wrong, Giovanni. And yet we have gold prices near, record levels, very close to record levels. And we've only just started to see a turn up in ETF demand. And the fundamental reason for that is that central banks have gone from buying no gold at all for about 20 years. In fact, net outflows of gold between the 90s and the early 2000s, to the global financial crisis, where central banks realised that QE meant that there was some undermining of this value in the US dollar. And that shifted central banks to come back to buying around the sort of 200, 300, 400 tonnes a year, to the beginning of the war in Ukraine, and that leading particularly the global south, the Middle East, Asia, those reserve managers really stepping up their purchase of gold. Now, we've seen purchase of gold over 1,000 tons a year, which is the highest level since the 1960s, just in the last 2 years. And we're probably lining up, perhaps not quite that much this year, but around that sort of 950, 900 tons this year. And this is very much based on this geostrategic sort of de-dollarization sort of trend that we're seeing, where these countries want to diversify their asset base. So while we have very high holdings from a percentage of reserves in the US, for example, we see countries like China where reserves are still quite low. They're only, 5-7%, somewhere around there as a percentage of total reserves, whereas other central banks are around the 20 to 50% of reserves. And so there's a lot of room to move, even if we have a relatively modest rate cutting cycle, as we talked about earlier. There is still a lot of room to move for these countries to add more gold, and this will only add to the additional purchases from ETFs. Hence, we're pretty confident we can reach this 2,700. But again, as I say, we have not factored in a recession in the US into these numbers. We have taken a soft landing approach for the US, and we merely see this structural demand for gold, if you can think about it that way, continuing over the next year or so. And these are the trends that are behind the gold price moving to 2,700. If we got a recession in the US, or we got some broader economic dislocation elsewhere, well, then that would only bring into vision this $3,000 an ounce price that you're talking about.
Well, yeah, and Giovanni, let me just ask you there, because it's interesting, that point that Wayne made there about the sort of expected ETF inflows, and maybe that this has come maybe a little later than one might have thought by instinct, the ongoing robustness of central bank demand. Has it surprised you, either the pace of those things happening or not happening, or the timing of them? Or does that kind of accord with your expectations if we go back, 18 months or so?
The rates view has been changing quite a lot, so that wasn't part of our expectation, and we were wrong on that side, and therefore our assumption on the ETF demand has been wrong, but we were holding a positive outlook, as Wayne mentioned before already, since the start of the year, and this has been driven by other factors dominating, and these factors are still in place. So it's the sum of all demand drivers which we need to look at. Central bank demand has come in very strong, definitely on the higher end of our expectation, and therefore it managed to compensate the weakness coming from ETF investors. And ETF investors are driven, as Wayne mentioned before, by rate cuts expectation. And at the start of the year, we were expecting 5 rate cuts. We are still at 0. We will eventually get 3 this year, but this change in expectation has influenced ETF flows, and therefore the gold price has been temporarily moved up and down, but the trend has been still a steady increase driven by Asian demand, and here clearly China stands out, and the central bank demand. So it's the addition of all demand driver which matter more, and clearly it's less the jewelry demand. Jewelry demand tries to be very price sensitive, so at record level, we see a slowdown. It's investment demand. And the drive of the investment demand is the factors that Wayne mentioned before: real interest rates, geopolitical fears, market volatility, dollar exchange rate. And this demand, particularly on the ETF demand, has been so far weak. And if we look at historical pattern, that should come, and therefore we can go back to higher levels. Does the 3,000 mark matter for markets? The question that you asked before, I think it's irrelevant if it's a round number or not. Definitely there are some market participants which like that level, and definitely, as you mentioned as a journalist, that's also the case for you. But otherwise, it's fundamentals which matter. And if we are going in the world that we see, then the gold price has room to move higher.
Now, gents, just maybe as a final thought, I always like to bring this back and sort of really underscore what the conversations, the observations, these trends that you've been describing, this focus on the fundamentals means for investors. And I guess the takeaway, to crudely simplify somewhat, again, a journalist lot in life, gold's going to keep its hold on investors, right? I mean, it's always interesting to come back to that despite all of the nuance, and you've given so much helpful detail, the fundamental is that it's going to stay relevant, right? And I guess that's always a good takeaway for maybe the lay investor who's listening in. Giovanni, to you first of all.
Well, someone was telling me the other day that already the Egyptian were discussing the gold-silver price ratio. So it's one of the assets with the longest history, and that is likely to stay. There is different camps of investors, some not believing in the role of gold, and they have eventually their merits, believing that gold should trade around production costs, and the other ones expecting that the gold price, like Bitcoin, will trade at extreme high levels. We try to find a way in between, and that's the way we try to handle the situation. We think the factors are still in place to lift prices from here.
Just to extend on to that, when you're thinking about it in a portfolio context, when we've looked at what is the optimal holding of gold where you're getting the maximum benefit, i.e. reducing the overall volatility of your portfolio and providing some insurance, if you could think about it that way, as Giovanni always loves to point it out as. So some insurance in the portfolio that provides you an ability to hold an asset that has no credit risk, no counterparty risk, is inversely correlated to one of the key asset denominations being the US dollar, has good liquidity that can be mobilized at any time. These are the key things that investors look for when they're buying insurance. And we've always sort of recommended, for a balanced portfolio, people thought about holding around 5% gold in that context. Now, I have clients who they will hold around 5% gold, and as prices rise and the volatility of other things in their portfolio pick up, they might find themselves with 7 or 8% within the portfolio as a percentage. And so there they begin to take a little bit of profit, and they begin to invest in other areas which have come down quite a bit. So that flexibility is also there for gold, while still providing that uncorrelated type of asset that has performed over generations, hundreds of years.
Wayne Gordon, and before that, Giovanni Staunovo, bringing us to the end of this edition of the Bulletin with UBS. You can listen again and explore more at monocle.com. That's where you can join the club and subscribe to Monocle magazine. You can also follow this programme wherever you get your podcasts. So do subscribe and rate the programme on Apple Podcasts. And as always, you can discover more and find out how UBS can help you by heading to ubs.com. This is the Bulletin with UBS on Monocle Radio. I'm Tom Edwards. Thanks for listening.